You earn more than your parents. On paper, you're richer. But in reality, you're living in an economy where the math has fundamentally broken. Housing, healthcare, education, the pillars of middle class life, all drifted out of reach. Not because you failed, but because the link between work and wealth snapped. Your parents lived during the rare moment in American history when productivity and pay rose together. Then somewhere around the late 1970s, the line split. But the consequences didn't show up overnight. They accumulated quietly, decade after decade. What you're feeling today is the bill from that break. In 1985, a median income household in the United States could purchase a median-priced home with roughly 3.2 years of pre-tax income. By 2023, that same median household needs 7.6 years of income to buy that same median home. The house didn't get twice as valuable. Your paycheck didn't lose its buying power in traditional inflation metrics. Something else shifted beneath the surface of the economy. Something fundamental that official statistics struggle to capture. This isn't a story about lazy millennials or avocado toast. This is about the systematic restructuring of how wealth accumulates, how capital flows, and who captures the gains from economic growth. The numbers tell a story that contradicts almost everything you've been told about meritocracy, hard work, and upward mobility. Between 1948 and 1979, productivity in the American economy increased by 108%. During that same period, hourly compensation for production workers increased by 93%. The gains from economic growth were shared, imperfectly but substantially, between capital and labor. Workers got raises that roughly matched their increased output. If you worked harder and produced more, you earned more. The system had a certain internal logic. Then something broke. From 1979 to 2020, productivity grew by 61.8%. Hourly compensation grew by just 17.5%. The gap between what workers produce and what they earn has widened into a chasm. Your parents lived in the first period. You live in the second. That divergence, that severing of the link between productivity and compensation, explains more about your financial anxiety than nearly any other single factor. But the story goes deeper than wage stagnation. Your parents weren't just earning relatively more. They were entering an economy structured differently at its foundation. In 1970, the top 1% of Americans held 21% of the nation's wealth. By 2020, they held 34%. The bottom 50% held 3.7% in 1970. By 2020, that figure dropped to 1.9%. Wealth didn't just stagnate at the bottom and middle. It actively transferred upward. This wasn't a natural evolution of market forces. This was the result of specific policy choices, legal frameworks, and economic restructuring that began in earnest during the late 1970s and accelerated through the following decades. Consider housing, the primary vehicle of wealth accumulation for middle-class families. In 1960, the median home price in the United States was $11,900, and median household income was $5,600. That's a ratio of 2.1 to 1. By 2023, the median home price reached $436,800, while median household income sat at $74,580. That's a ratio of 5.9 to 1, even accounting for differences in home size and features. The fundamental math shifted decisively against buyers. But the housing crisis represents just one facet of a larger transformation. The entire structure of the economy has reoriented away from wage-based income toward asset-based wealth. This matters because wages and wealth compound differently. Wages are linear. Wealth is exponential. Your parents could buy a home with a conventional 30-year mortgage at 7 or 8% interest and reasonable down payment requirements. Banks were boring institutions that took deposits and made loans, operating under strict regulatory frameworks established after the Great Depression. Financial products were simple: 30-year fixed mortgages, savings accounts, certificates of deposit, maybe some conservative stock holdings. Wealth accumulation followed a predictable path. The deregulation of financial markets beginning in the 1980s transformed that landscape entirely. The repeal of key provisions of the Glass-Steagall Act in 1999 removed the walls between commercial and investment banking. Financial institutions could suddenly merge deposit taking with securities trading. Banks became massive, interconnected entities dealing in complex derivatives, mortgage-backed securities, and exotic financial instruments that even their own risk managers struggled to understand. This financialization of the economy meant that capital increasingly earned returns, not from producing goods and services, but from financial engineering. Between 1980 and 2019, the finance and insurance sectors grew from 4.9% of GDP to 7.4%. That growth came with a cost. Financial sector profits as a share of total corporate profits rose from around 10% in 1980 to peaks above 40% before the 2008 crisis. That money had to come from somewhere. It came from labor's share of national income, which fell from 64% in 1974 to 57% by 2017. The economy grew. Corporations posted record profits, productivity climbed, but the workers producing that value captured less and less of it. Your parents entered the workforce during the tail end of what economists call the Great Compression, a period from roughly 1940 to 1970 when income inequality narrowed significantly. Union membership stood at 27% of the workforce in 1979. By 2023, it had fallen to 10%. This wasn't a natural decline. The Taft-Hartley Act of 1947 placed significant restrictions on union activity. Right-to-work laws spread across states. Court decisions and National Labor Relations Board rulings tilted increasingly toward employer interests. President Reagan's firing of 11,345 striking air traffic controllers in 1981 sent an unmistakable signal. Workers had lost their leverage. Without collective bargaining power, wages became subject purely to market forces in labor markets, where employers hold structural advantages. Monopsony power, the labor market equivalent of monopoly, allows large employers to suppress wages below what competitive markets would produce. A 2018 study estimated that the markdown of wages below marginal productivity due to labor market concentration averaged 23%. You produce $100 of value per hour, but receive $77. Your employer captures the difference. Meanwhile, the cost structures you face look nothing like those your parents encountered. Healthcare provides the starkest example. In 1960, healthcare spending represented 5% of GDP. By 2023, it consumes 17.3% of GDP. For individuals, the numbers are even more striking. The average annual premium for employer-sponsored family health insurance reached $23,968 in 2023, with workers paying $6,575 of that cost directly. That's nearly 9% of median household income going just to insurance premiums before any actual healthcare consumption. Your parents had pensions, defined benefit plans, guaranteed specific retirement income based on salary and years of service. The employer bore the investment risk. By 2023, only 15% of private sector workers had access to defined benefit pensions. The shift to 401k plans transferred risk entirely onto workers. You must contribute your own money, make your own investment decisions, and hope the market performs well during your working years. The median 401k balance for Americans aged 55 to 64 stood at just $61,738 in 2022 at a 4% safe withdrawal rate that provides less than $2,500 annually in retirement income. Education costs followed a similar trajectory. In 1980, the average cost of tuition, room, and board at a 4-year public institution was $7,587 in today's dollars. By By 2023, that figure reached $27,940. For private institutions, the jump went from $17,680 to $60,420. Student loan debt ballooned from $241 billion in 2003 to $1.77 trillion by 2023. Your parents could work a summer job and cover a significant portion of their college costs. That mathematics became impossible decades ago. But perhaps the most insidious change operates at the level of time itself. Your parents bought homes that appreciated while they slept. They invested in pensions that compounded automatically. Their employers provided healthcare and retirement security. They could focus their human capital on their work, their families, their communities. You must constantly manage financial complexity. Research health insurance options during open enrollment. Rebalance investment portfolios. Understand the tax implications of various account types. Navigate multiple income streams because single employment no longer guarantees security. The gig economy demands you become entrepreneur, accountant, and benefits administrator simultaneously. This cognitive load has real costs. Research suggests that financial stress reduces cognitive capacity by the equivalent of 13 IQ points. You're not just poorer, you're operating with less mental bandwidth because poverty itself depletes cognitive resources. The wealthy face none of these constraints. When capital grows faster than the economy overall, when asset prices appreciate faster than wages, when you can borrow against appreciated assets at low interest rates and invest the proceeds at higher returns, wealth becomes self-reinforcing. The economist Thomas Piketty documented that return on capital has consistently exceeded economic growth throughout history, except during brief periods of major disruption. His central formula, R greater than G, describes an iron law. Capital income outpaces labor income over time unless something intervenes to disrupt the pattern. Those interventions happen for your parents' generation. The Great Depression led to massive policy reforms. World War II and its aftermath created labor shortages that strengthened workers' bargaining position. The GI Bill democratized access to higher education and homeownership. Progressive taxation reached its peak, with top marginal rates above 90% in the 1950s and 1960s. Estate taxes captured significant portions of inherited wealth. Corporate governance norms emphasize stakeholder capitalism over pure shareholder value maximization. Each of those counterweights has eroded. Top marginal tax rates fell from 70% in 1980 to 37% today. Capital gains, the primary form of income for the wealthy, are taxed at preferential rates compared to wage income. The estate tax exemption reached $13.61 million per individual in 2024, up from $600,000 in 2001. Corporate governance shifted decisively towards shareholder primacy following Milton Friedman's influential 1970 essay, arguing that a corporation's only social responsibility is to increase profits, stock buybacks, essentially illegal until a 1982 SEC rule change allow corporations to return cash to shareholders rather than investing in workers or productive capacity. Between 2010 and 2019, S&P 500 companies spent $5.3 trillion on buybacks. The offshoring of manufacturing gutted the industrial base that provided middle-class wages to workers without college degrees. Between 2000 and 2010, the United States lost 5.8 million manufacturing jobs, roughly one-third of the entire manufacturing workforce. Those jobs paid median wages of $52,000 in 2020. The replacement jobs in service sectors paid median wages of $32,000. You can argue about the aggregate economic efficiency of trade liberalization, but the distributional consequences are unambiguous. Capital benefited, labor lost. Technology accelerated these trends. Automation replaced routine cognitive and manual tasks. The labor market polarized into high-skill, high-wage jobs and low-skill, low-wage jobs, with the middle hollowing out. A 2017 study estimated that one robot per 1,000 workers reduced the employment to population ratio by about 0.2 percentage points and wages by 0.37%. The robots are becoming more capable. The displacement is accelerating. Even the inflation statistics that supposedly prove your purchasing power hasn't declined rely on methodological choices that obscure lived reality. The Consumer Price Index uses substitution effects, assuming that when steak becomes expensive, consumers substitute chicken, and therefore the cost of living hasn't really increased. It uses hedonic adjustments, arguing that today's laptop is more powerful than yesterday's. So even if it costs the same, you're getting more value. These adjustments have economic logic. They also systematically understate the actual cost of maintaining a consistent standard of living. Housing costs receive particularly problematic treatment. The CPI measures owner equivalent rent rather than home prices. This smooths out volatility, but means that when home prices double, it barely registers in inflation statistics. You know housing became unaffordable. The official numbers suggest everything is fine. Meanwhile, the Boston Commission's 1996 recommendations led to changes in how CPI is calculated, changes that conveniently reduce measured inflation, and therefore reduced cost of living adjustments for Social Security, federal pensions, and inflation-indexed bonds. The government's debt burden decreased. Your purchasing power calculations became less accurate. The COVID-19 pandemic threw these structural issues into sharp relief. Between March 2020 and November 2021, U.S. billionaires saw their wealth increase by $2.1 trillion. A 70% jump, the total wealth of billionaires reached $5 trillion. During that same period, 100 million people globally were pushed into extreme poverty. The pandemic didn't create these inequalities. It accelerated existing trends and made them impossible to ignore. Central bank responses to the 2008 financial crisis and the 2020 pandemic involved massive quantitative easing, the creation of trillions of dollars that flowed primarily into asset markets. If you owned stocks, real estate, and bonds, your wealth soared. The S&P 500 more than quadrupled from its 2009 low to early 2020. If you relied on wages, you received whatever the tight labor market could extract from employers, with a real wage growth remaining relatively flat for most of that period. The Federal Reserve, attempting to stimulate the economy and prevent deflation, inadvertently engineered one of the largest wealth transfers in human history. Your parents lived through some inflation. The 1970s saw significant price increases, but they also saw wage growth that kept pace or exceeded inflation for much of their careers. Their homes appreciated, their pensions compounded, their dollars tomorrow were worth less, but they had more dollars and more assets. You face a different calculus. Asset price inflation runs rampant while wage inflation remains suppressed. The things you need to build wealth, homes, and education, and investment capital become more expensive faster than your income grows. The things you already own, if you own anything, might appreciate. But getting to that position of ownership requires overcoming barriers your parents never faced. This isn't about individual choices. This is about the architecture of the economic system. You can optimize your personal finances, learn about investing, avoid lifestyle inflation, and still find yourself falling behind relative to where your parents stood at the same age. The system is producing this outcome by design, not by accident. Consider the case of Germany, where different choices produced different outcomes. German manufacturing remained robust through strong labor representation on corporate boards. Works councils give employees formal input into business decisions. Vocational training programs create pathways to well-paid skilled trades without requiring expensive four-year degrees. Income inequality while present, never reached American extremes. The Gini coefficient for Germany measured 0.29 in 2019 compared to 0.39 for the United States. Both are capitalist democracies. Both are highly developed economies. Yet their distributional outcomes differ substantially because their institutional frameworks differ. The same applies to housing. Vienna maintains vast amounts of social housing, with 43% of residents living in subsidized apartments. This keeps market rate housing affordable because the alternative isn't homelessness, but decent public housing. Singapore's Housing Development Board owns roughly 80% of residential property, selling 99-year leases to residents at cost. Tokyo liberalized land use regulations and allowed density, resulting in housing prices that remained relatively stable even as the city grew. Different policy choices produce different outcomes. The question isn't whether the current American system is the only way to organize a market economy. The question is why the United States chose this particular configuration and who benefits from maintaining it. The answer lies in political economy, the study of how economic and political power interact and reinforce each other. Wealth translates into political influence through multiple channels: campaign contributions, lobbying expenditures, think tank funding, media ownership, revolving doors between government and industry. The top 0.01% of Americans by income account for 40% of campaign contributions. The preferences of economic elites and organized business groups have substantial impacts on government policy, while average citizens have little or no independent influence. This isn't conspiracy theory. This is empirical political science research based on analysis of 1,779 policy issues. When business interests oppose labor law reforms that would make union organizing easier, those reforms failed despite popular support. When financial institutions wanted deregulation, they got it despite evidence that it increased systemic risk. When pharmaceutical companies wanted to prohibit Medicare from negotiating drug prices, that prohibition was written into law. When corporations wanted to repatriate overseas profits at reduced tax rates, they received multiple tax holidays. Policy consistently bends toward capital and away from labor. This happens through legal processes, not through coercion, but it happens predictably and repeatedly. Your parents lived during a brief window when labor had captured enough political power to demand concessions. The New Deal coalition brought together unions, urban machines, and progressive reformers. Their political strength forced compromises that created Social Security, Medicare, workplace safety regulations, environmental protections, and civil rights legislation. The business community had to accommodate this balance of power. That coalition fragmented. The Southern strategy peeled away white working-class voters using racial resentment. Deindustrialization weakened unions. The rise of identity politics and cultural issues divided potential economic coalitions. The Powell Memorandum, a 1971 document written by future Supreme Court Justice Lewis Powell, laid out an explicit strategy for business to reassert political dominance through coordinated action. What followed was the construction of the institutional architecture that shapes policy today. The Heritage Foundation, American Enterprise Institute, Cato Institute, Federalist Society, and dozens of other organizations funded by business interests to shape public discourse and legal doctrine. None of this is hidden. The mechanisms operate openly, but they operate effectively. You are poorer than your parents, not because you work less hard or lack discipline. You are poorer because the system now extracts more value from labor and concentrates more gains with capital. You are poorer because housing, education, and healthcare became investment vehicles rather than social goods. You are poorer because wage-setting mechanisms changed. Risk shifted from employers to employees, and public goods privatized. The future trajectory is unclear. Inequality has continued growing, but history suggests these dynamics don't continue indefinitely. Something breaks. Either reformist politics succeed in rebalancing the system, or crisis forces restructuring, or conflict erupts. The Gilded Age eventually produced the Progressive Era. The Roaring Twenties led to the New Deal. The question is, what catalyst will disrupt current arrangements, and whether the disruption will be managed or chaotic. The discourse often frames these issues as generational conflict, boomers versus millennials. But this obscures the real dividing line. Older workers without assets face the same struggles. Younger workers with inherited wealth enjoy security. The relevant variable is capital ownership, not birth year. Your parents aren't your enemies. The system that worked for them was dismantled. You're living in the aftermath. What happens when an entire generation discovers that the implicit social contract, the promise that hard work and education lead to security and upward mobility, was broken before they entered adulthood? What happens when people earning solid middle-class incomes still can't afford the markers of middle-class life that their parents achieved on lesser incomes? What happens when there's no policy cavalry coming? Because the political system responds to wealth, and wealth is increasingly concentrated? History suggests that societies with high inequality and low mobility face difficult choices. They can reform their systems to restore opportunity and broadly shared prosperity. They can maintain control through various forms of suppression, or they can experience rupture. None of these paths are pleasant, but continuation of current trends indefinitely seems implausible. The math doesn't work. You can't have a consumer economy when consumers have no money. You can't have political legitimacy when the system clearly serves narrow interests. You can't have social cohesion when class mobility freezes. So you earn more than your parents, but feel poorer. The feeling reflects reality. The structures that translated income into wealth eroded. The barriers to asset accumulation rose. The risks shifted downward. The gains flowed upward. This happened through thousands of individual policy decisions, legal changes, and institutional shifts. It happened in the open. It happened with democratic consent, however manufactured that consent might have been. And now, you live in the system those decisions created, wondering why hard work isn't enough anymore. Why the math doesn't add up, why the future feels more precarious than it should. The answer is that the game changed. The rules were rewritten, and nobody asked if you wanted to play by the new rules. They just handed you the bill.